Welcome to The Explainer. Today, we are taking a journey way beyond the basic idea of just buying a stock and sitting on it for decades. We're going to peel back the curtain and look directly into the deep mechanics of Wall Street trading. We'll be exploring the rigid math that powers profitable systems, the high-stakes world of short selling and margin, the hidden tax traps that catch even the seasoned pros, and finally, how cutting-edge artificial intelligence is attempting to automate this entire complex pipeline. Let's get right into it.
Okay, let's dive into this. When a lot of people look at active, algorithmic, or high-frequency trading, you know what they see? They see a casino. They just see traders guessing which way a squiggly line on a chart is going to go. But actually, scratch that. That's a fundamental misunderstanding. Professional trading, it really isn't about guessing the future at all. It's about structuring your mathematical exposure to the market. It's moving from pure luck to the rigid science of probability. There's this fantastic quote from Forex Dominion that reveals the true secret of long-term profitability in literally any financial market. It says, "To make money with a trading system, it is not necessary to win on all trades. For a system to be profitable, it must have a positive mathematical expectation." And wow, that is profound, right? It totally removes the intense pressure of having to be right every single time. Think about it. You can actually lose more trades than you win and still come out highly profitable, as long as your system sticks to this one foundational rule of positive expectation. So how does that actually look on paper? Well, the formula behind this is surprisingly simple. Mathematical expectation, or expected value, is just your probability of winning multiplied by your average profit minus your probability of losing multiplied by your average loss. That's the whole shebang. If that yields a positive number, you've got a system that works over the long term. Now, to be clear, it doesn't tell you anything about winning or losing streaks or the crazy volatility you might face tomorrow. But it guarantees that if you execute your strategy consistently across a large enough sample size, the math will eventually tilt in your favor. Now, what's really interesting about this slide is the terrifying irony of how traders try to capture these probabilities. See, when you take a long position, buying a stock hoping it goes up, the absolute worst thing that can happen is the stock drops to zero. Your maximum loss is capped at your initial investment. But a short position, that is the exact mirror image. You're betting the stock will decline. You sell high, hoping to buy low later. But here is the kicker. Because a stock's price theoretically has no ceiling and can rise to infinity, short sellers face unlimited, infinite risk. Literally, if the stock explodes upward, your losses have absolutely no cap. Because of this massive, infinite risk, you can't just short a stock using a normal, everyday cash account. You absolutely must use margin. Now, margin involves borrowing shares or cash from a broker to make a trade. When you short sell, you are essentially borrowing shares from another investor, selling them out into the market, and promising to buy them back later to return to the lender. And because you're selling something you don't actually own and your losses could theoretically be infinite, well, brokers require strict collateral to protect themselves. That collateral is the equity sitting right there in your margin account. To really see just how seriously regulators take this risk, let's look at the math. The Federal Reserve Board enforces something called Regulation T, and what that dictates is that to execute a short sale, you have to deposit a massive 150% of the value of the position at the very moment the trade is executed. Yeah, 150%. That's the full 100% value of the shorted stock, plus an additional 50% margin requirement right on top of it as a strict financial buffer. This ensures that if the trade goes immediately against you, the broker has enough of your capital on hand to liquidate your position long before you default on those borrowed shares. Okay, so why does all this complex plumbing matter to you? Well, because borrowing shares isn't free. Supply and demand dictate borrow rates, and those can fluctuate wildly every single day. And beyond the borrowing costs and those really intense margin requirements, there is an entire labyrinth of tax rules just waiting to penalize your mistakes. The IRS, after all, never misses a chance to participate in your trades. So we're shifting gears here, moving from the theoretical math of trading directly into the practical, sometimes ominous impacts on your actual wallet. But wait, before we get to the IRS, we need to look at what happens when the margin requirements we just discussed break down on a massive scale. It's called a short squeeze. Remember, if a shorted stock goes up in price, the short seller loses money. If it goes up too much, the broker issues a margin call, basically demanding more collateral. Now, if the trader can't pay, the broker automatically buys the stock back to close the position. But here's the crazy part. Buying that stock drives the price up even further, which triggers more margin calls for other short sellers, forcing them to buy. It creates this chaotic, explosive, positive feedback loop, where the very act of trying to escape the trade actually drives the market higher and higher against the short sellers. And this brilliantly illustrates how these multi-billion-dollar anomalies actually happen in the real world. These events aren't just rare textbook theories, they are market-defining phenomena. Back in 1901, a short squeeze on Northern Pacific Railway sparked a massive stock market crash. Fast forward to 2008, an unexpected takeover attempt triggered a massive squeeze on Volkswagen. And for a brief, truly bizarre moment, VW became the most valuable company in the entire world as desperate shorts scrambled to buy shares. And of course, in 2021, we all saw the GameStop rebellion, where retail traders recognized that short interest was incredibly high, and they intentionally triggered a massive squeeze against institutional hedge funds. It spread like wildfire. So let's say you survive the volatility, the math, and the margin. Well, you still have to face the tax man. We are now transitioning deeper into the iceberg, because understanding the market mechanics, that's really only half the battle. The other half is navigating the murky, highly complex world of trading taxes, which quite frankly can completely erode that positive mathematical expectation we talked about earlier if you aren't super careful. Let's look at some research from Charles Schwab outlining a few of these brutal traps. First up, the wash sale rule. You sell a loser and buy a substantially identical one back within a 61-day window, bam, the IRS simply disallows your loss. Then there's constructive sales. Let's say you try to hedge a winning stock by shorting it to lock in your profit. Ironically, the IRS treats it as a sale, and you owe taxes right then and there, even though you never actually sold your original shares. No way, right? And finally, substitute payments. If your stock is lent out to a short seller from your margin account, the dividend you receive is considered a substitute payment, which gets taxed at higher ordinary income rates, completely losing those favorable qualified dividend rates. So the crucial point is how the IRS fundamentally views short selling. Look at it this way. When you close a short position, you're buying shares on the open market at that exact moment to return them to the broker. Because those shares were just freshly purchased, they are considered to be held short term. It literally doesn't matter if you kept that short position open for 3 whole years, the gain is almost always going to be treated as a short-term capital gain, meaning it gets hit with your standard, much higher ordinary income tax rate. Between calculating expected values, managing 150% margin requirements, surviving short squeezes, dodging 61-day wash sale windows, and tracking substitute dividend payments, wow, the cognitive load on a human trader is simply overwhelming. It's like a giant puzzle. And this is exactly why the quantitative AI revolution is taking over. We are entering an era where cutting-edge, awe-inspiring technology is stepping in, attempting to manage this incredibly complex web of math, margin, and taxes with absolute, emotionless precision. This brings us to FinRLX. It's this incredible, open-source, AI-native infrastructure detailed in a recent research paper designed to unify the entire quantitative trading pipeline. It beautifully breaks the chaos down into 4 distinct, manageable layers: data ingestion, strategy formulation, backtesting, and live trade execution. But what makes this architecture truly a game-changer is its weight-centric interface. Whether the system is picking stocks, adjusting portfolio weights, timing the market, or managing risk, all the AI modules output one simple thing: target portfolio weights. This unified language allows the entire system to seamlessly translate super complex AI signals into actual executable trades. Let's move to and see how this builds a bridge between theory and reality. You know, academic models often completely fail in the real world because of what we call deployment gaps. But FinRLX is designed specifically to fix these. First, it overcomes the backtesting to paper gap. It strictly stops the AI from assuming it gets instant fills at perfect prices without transaction costs. It forces the simulation to reflect actual broker reality. Second, it bridges the paper to live gap. Even good paper trading fails in live markets due to API latency, strict margin rules like Regulation T we just talked about, and infrastructure crashes. FinRLX builds in state persistence, fault tolerance, and margin awareness. It takes sterile, simulated research and translates it into an incredibly resilient, real-world live market execution engine. So we've seen how strict the math of expected value truly is. We've seen the infinite risks and those massive 150% margin requirements of shorting. We've navigated the complex, frankly punitive world of IRS trading rules. And now we see AI infrastructures like FinRLX seamlessly automating all of it, from raw data straight to live execution, completely free from the panic or emotion that causes human errors.
It really forces us to ask a profound question. As AI systems master the math, perfectly manage the margin, and flawlessly navigate the taxes, is the discretionary human trader becoming obsolete? It's a fascinating thought to leave you with. Thanks so much for joining me on this explainer, and keep questioning how the market really works.